Today's market call is presented by FactSet, financial data and analytics powered by tomorrow.
Dogs and cats living together. That's what today is.
Mass hysteria.
Mass hysteria.
Yeah, what movie? People put it in the chat. We're not going to tell you. One of the last.
Doug Cass yelled at me yesterday. I didn't say REM was in the 90s. I was in college when REM came out.
He's talking to me for whatever reason. I told him in 1982, I was 10 years old. All right, Guy, what is the mass hysteria?
Well, it's market call, by the way. It's Friday, October the 10th, double digits in the month of V as in victory.
10,
mass hysteria, I mean, listen, we had not planned to do this, but about an hour and a half or so ago, and we throw an S&P chart up, a daily chart, just to sort of show you what happened. It seems as though the president was a little bit agitated, and they're ratcheting up some of the rhetoric in terms of tariffs around China. And, you know, as Cece pointed out, and as you said yesterday, you know, what happened to the tariffs? Well, it only took 24 hours for that to sort of manifest itself. And here we are now. I'll say this. I think given the levels of the markets, given some of the metrics we've talked about, you know, given some of the overbought conditions that we have been talking about now for a long time, I'd say in a normal circumstances, you know, this move would not be to the extreme that we're seeing now, and especially manifesting itself in the VIX, which for the first time in a long time, Dan, we're sitting here either side of 20.
Yeah. You know, it's crazy. I think the long-term average, I think the VIX guy was created in 1990. The long-term average has been 20, but in the age of quantitative easing, you know, you see that I bet on the last 10 years, it's been in the mid to low teens. This sort of move, I mean, so we can go back to early August, guy. I think that was the July print, the jobs print, right? We had that kind of quick move towards 20, quickly went back towards making new highs, you know, like that breakout that we saw. You know, what the VIX here tells me is the level of complacency. And we've been talking about that complacency. We've been talking about it in the options market, the skew towards calls over puts, which made puts that much more attractive if you were looking for protection. You know, that let's go back to the intraday of the S&P. You know, we haven't seen too many of these in a very long time. Oftentimes you'll see, you know, some headline comes out. We call them tape bombs, right, guy?
Yes, we do.
This is a tape bomb in really complacent, you know, environment. And it'll be interesting to see how we close, because this is one of the days I would say we might see the sort of rally. How many handles was that guy off of the?
No, I mean, today we traded up to 67.60, I think, and here we are at 66.30. So that's 130-ish handle reversal. And again, what's today? It's 12 o'clock. So you still have 4 hours left in the day. Now, it's funny. Amanda, prior to this show, said probably close green on the day because she, like myself, has become conditioned to sort of expect these things. But yeah, on a Friday, again, given the way the market is setting up, given the complacency that you just talked about vis-a-vis the VIX, I mean, this has one of those feelings that, you know, the weekend is sort of sketchy, and then you come in Monday and God only knows what could happen.
Well, and so the point I was going to make, and Amanda, if she's right, you're going to listen, there could be a headline that turns the whole thing. Yeah. I mean, we've seen that before, but look at off that low, guy. It was about like at 11:35 or something like that. We had a 40 handle rally. I mean, think about that. So 66.20 to 66.60. You saw sellers come in. So now we're focused on that 66.20 level, right? Because that is the prior low from just 40 minutes ago. And then the low, if you want to do like a 1 month chart here, on September 25th, guy, we got down to, I think it was below 6,600. So we're probably looking at I don't know, 50, 60 handles, 50 handles, right? And so that's kind of your next level if you're looking at, they're thinking about it that way.
So if I don't have this in front of me, you use those, what do they call those things? Chat bots or something?
You call them chat bots.
But, it would be interesting to see what the low of the S&P was, excuse me, in the prior month of September. And if I had a guess, and I don't know this, it's probably about 6,500-ish. And if you could find out. Now, the only reason I bring that up is because here we are at 66.35. We obviously made a new all-time high this month. So now you have to start looking at, the low in September. So if we were to somehow close below that low, again, understanding that there's 3 weeks left in the month, then things all of a sudden get very interesting, very interesting, very quickly.
Intraday low on September 17th, which is also Fed day. So like that's what you had is all that volatility. It was like 65.50. I think like a closing low guy might have been 65.80. So here we are at 66.30. So let's see, 65.80 is really the next level. You know, we talk about those chat bots, as you call them. Let's go to Perplexity or ChatGPT, Jacob or Amanda, and just find out when was the last day the S&P 500 closed down. Let's call it 1.5%, because I think it's been a minute, guy.
It's been a minute.
It's been a minute.
And you know, Amanda will be Johnny on the spot with this.
Oh my God. So just as a little backup here, people, while we were waiting to go on, you and I were going through expressions that we absolutely hate. And I think we just nailed the two of them. Here's another one that just gets in my, I can't, if you were on Wheel of Fortune, you know how you have to buy vowels, right? Isn't that Wheel of Fortune? Would you ever say, if you were going to say, one or the other, you know what I mean? If you were to say 6 to 1, half a dozen to the other, you had to buy vowels, you would never say that. You just say one or the other.
Yeah. Listen, I mean,
that is one of the dumbest expressions. The first time I ever heard it, I think my wife, then girlfriend, I almost dumped her. I'd never heard that expression before. Not particularly happy about it. I said, that's the dumbest effing thing I've ever heard. Guy, what do you want? You want to go to the semis here for a second? Because
I think that's important, because I think a lot of this, I think the bullseye once again finds itself on the back of the semis, which, by the way, I'm surprised. Again, you have an S&P down 105 handles ish. If you had told me all this was going to take place and, this would be the headline we get, and you say, okay, where's NVIDIA going to trade? NVIDIA, which, by the way, made a new all-time high today at 195.62 off that upgrade yesterday, and sort of you have a continuation of that theme. I would have said NVIDIA's got to be, $180 ish, a lot lower than we are now. Now, again, there's time left in the day, but it's actually, in my opinion, given what we're seeing, it's hanging in there pretty well. Now, in terms of the rest of the semis, that remains to be seen. We have a pretty cool Broadcom chart comes out of Vago that we want to take a look at. Semis are down about 3.5% today, but NVIDIA surprisingly holding in there.
Yeah, and this goes back to yesterday, Guy, when the Chinese were, and you and I were really surprised that we did not see more volatility around this, because President Trump has been talking about, like, basically talking up the potential for some sort of deal with China. He was going to go see Xi at some point. We didn't know where, but later this month. So the Chinese then go and put some export bans on some rare earth materials. So the question, first things first, is where did that come from, right? And then when you think about, the comment that we just made here, despite lifting some of those export bans, the White House did last month, right? And they put a VIG on the sales. The Chinese then went to their, buyers of those such things, and they said, we don't want you buying them. So maybe there's been basically, a breakdown in communication, the back channels, and then Trump just, wakes up this morning for whatever reason and is unhappy about something. The other thing I'll just say is he's supposed to go to Israel too in the next few days or so. So
over the weekend.
This is, this is an important time. There's lots of things going on. There's things going on domestically with, all this back and forth with, sending, troops into these states. There's a bunch of stuff going on with the Supreme Court and lower courts trying to block some of this stuff. You have all the geopolitical stuff. You have the Russians turning up attacks in Ukraine, and so look at all this stuff. It doesn't feel like things are particularly calm in the world right now.
No, I agree with that. And, yes, I agree with everything you just said. I'll say this as well. And this is something we've talked about. If an administration that, although they don't say it like they did during the first administration, 216 to 220, this is one that is absolutely focused on the stock market when the stock market does well. So when you're talking about an S&P, which, as I just mentioned, made an all-time high today, I think the calculus is, and this is just me, I think the calculus is, we have some equity in the equity market, not to try to be clever, but I think that's how they think. And they can throw headlines, so they can throw rhetoric out like this, understanding that it's going to affect the market, but understanding that they're dealing from a position of strength. I also think that there's some thought around, how can we get yields? And, people say you're nuts. How can we get yields lower? Well, one of the ways to do it is vis-a-vis this type of thing, because in an event like today, when you see a market sell-off, at least like we've seen, you historically get this flight to perceived quality in the form of the bond market. And we are seeing TLT up about a little over one handle or so today, which is a big move. I will say this, and then I'm curious as to your thoughts. As much as people are running to the bond market today, I don't think this is at all bond bullish. As a matter of fact, I think when clearer heads prevail, I think people realize that actually this is bond bearish.
Yeah, and that's something, bond bearish is higher yields, right? And who knows, when you have this sort of disruption or higher tariffs mean, we know what that means, right? It means inflation. It means that companies at this point, we're 7-8 months into the administration, where a lot of these companies were bracing for higher tariffs. They were willing to kind of eat in terms of margins some of these higher prices before they started pushing those costs through to consumer. We had some consumer data here. The consumer is hanging in there, but different parts of the consumer are having a tougher time, right? So when you think about, there's two things I think to focus on. Oh, we haven't even mentioned the government shutdown ending, entering.
It's amazing, right? I mean, think about that. We didn't mention it, and we're in our third. Are we in our third week next week?
No, it's going into the second weekend, so we're like a week and a half at this point.
But it's pretty remarkable that, given the backdrop of everything, we didn't even mention that, because I think the market's come to the realization that at some point it's going to end, and it's very hard to trade. I mean, if there's anything that was ever transitory, it's probably this. But you're right to bring it up.
Well, one of the main reasons I bring it up is because some of the threats by the White House is that they're going to permanently fire a whole host of people. And this comes after the Doge sort of situation. So we've seen government hiring was a big part of the jobs picture over the last few years. And now that's gone away. So let's just say you have all these folks that are furloughed. You have the threat of people being fired. What do you think that does to consumer confidence, right?
Well,
So
no, I mean, it's yeah, absolutely. I mean, and by the way, I mean, a consumer confidence that I think in large part is sort of predicated on how well the stock market is doing. Again, not to suggest that everybody owns stocks. That's not my point. But I think for the most people, look at the stock market as a barometer for how things are going. So when it goes up every day, they feel good about things. Now, I will also say there are a lot of people that, without question, have been and continue to be hurting in terms of living paycheck to paycheck. I mean, we talk about this all the time. So this chasm between the have and the have-nots continues to widen out. But, if you were to see a prolonged market sell-off, and again, what the hell do I know, but on the back of a government shutdown with all the geopolitical things you're talking about, yeah, I think as we enter this holiday season, which we are pretty much in the midst of now, I think people are going to start to think twice about spending habits.
Yeah. And again, it goes back to corporate earnings. So if we see some margin pressure because all of that, because they're either eating it, but ultimately they start to pass through some of these increased costs, then you might kill some demand, right? And that just makes sense. Our crack team guy came up with these data, and we'll just finish on the S&P. I want to go back to semis in a second. So the last time the S&P closed down 1.5% was on August 1st. And it actually fell 1.5%. And then CC tells us that was Amanda, just Johnny on the spot. We'll just use that again. CC says that pullback in August that we had around the July jobs data was 3.5%. This is something that we've seen in the S&P over the course of this since the August lows. The sell-offs are just tiny. They're a couple days, 2-3 days. They're no more than that.
I mean, if you look at that, I mean, it was July 28th, I think, that the S&P was making a new all-time high around 6,400. And then, as you mentioned, I think we bottomed out on August 1st, 6,200-ish maybe? I don't know. So, I mean, it's not like it cascaded lower. And then within a couple of days, we're right back to making new all-time highs.
Yeah. So just to finish on the semis guy, because it's the leadership group here. So Taiwan semi, and we know what's been going on there off those recent lows. And you're going to see this. It had like basically a 30% rally. This is on that breakout. Look at that, right? So you see that from early September. The company issued September sales better than expected. I think next week they're going to report earnings. These are tough setups in general, right? Into the earnings season. We know we have banks really start, I think, mid to late next week. Maybe on Thursday, you get a bunch of those money centers. But when we think about setups into earnings, you generally don't want to see these sorts of rallies because it's discounted a lot of the good news. So, like this might be a great thing if you are bullish. Mike Wilson from Morgan Stanley was on Fast Money with us last night, and about a year ago, he turned bullish. I want to say he was bearish, for a while in 24. A lot of folks were giving him a lot of shit. He was talking about rolling recessions in different industries, which we clearly saw. The indices were powered by obviously these top 10 names or whatever. But he thought near term we could have a pullback because of expectations too high. So generally, this is a tough setup into earnings season.
I agree 100% with that. I mean, if you want to throw other things into the mix, and we'll talk about sort of what we're looking for over the next couple of weeks. But look at the home builders. And this is one I think we've done a really good job. I mean, pull up the home builder of your choice. I mean, that's the XHB, which is right at this 200-day moving average, which is fine. But now look at like a Toll Brothers, which we talked about yesterday. You want to throw a Pulte Homes in. And they're all going to be very similar. They all made their all-time high in the fall of last year. They all cascaded lower like everything else into April. They all bounced, but not nearly to the magnitude of the broader market. And now they're all selling off. And most of them are pretty critical support. So you talk about confidence and labor market and all those different things. Well, these stocks to me, right on the precipice. I think they, by the way, I want to be clear. I said it last night. I've been saying it. I think they go lower, but these are pretty critical levels that we find ourselves at.
And you have a 10-year, pressing at 4% again. And we were talking about, a lot of these home builders have been buying down rates, 6.3% on the 30-year fixed. That's right now. A year ago, Guy, the 30-year fixed was 6.3%. And look at how much worse, the home builders act on a relative basis. Hey, listen, we're going to do something really fun. The reason we went live right here, because Guy and I were going to tape a preview of the next week for the Risk Reversal podcast that was going to drop on Monday morning. So we're going to do that right now. We just wanted to hit some of that stuff just to get warmed up a little bit. And I'm just going to start this, Guy. Welcome to the Risk Reversal podcast. I am Dan Nathan. That's Guy Adami. We're going to give you a little bit of preview of what we expect to be the most market driving events on the week. And we're going to take a look back quickly on Friday, the volatility that we saw that seemed to be threats from the White House about increased tariffs on China, Guy.
No doubt about it. And, obviously this is not a Friday night dirty because it didn't happen after the close, but, maybe it's a variation of the theme, a Friday dirty. But regardless, I mean, this seemingly came out of nowhere. Although I will say, you had been talking about, where are the tariffs for quite some time. Well, here we are. So let's sort of break it down. And the thing that stands out to me is what we saw in the volatility index, because volatility has not been a theme, Dan, yet in one single day, all of a sudden you're seeing an outsized move in volatility in terms of what the broader market has done. Now, this is obviously a soft of the magnitude we haven't seen all that often, but to have the VIX up, and I'm going to use it in percentage terms, so please don't at me on Twitter, but to have the VIX up 4 handles, which is 26%, that to me is very, very telling in terms of the temperature of market participants.
Yeah. And so going back to April, when we were in the throes of the kind of tariff rollout, we saw, a VIX go from the mid-teens up to 60 almost. And, it spent some time, above 40, Guy. And then what did we see? We saw it kind of cratering in. We had that little taco trade. Remember the chicken out sort of thing. And then we were back in the mid-teens and we kept on grinding higher. We haven't had more than a 3.5% sell-off that came in early August after the disappointing July jobs report. And we were down, I think, 1.5% on that first day. And that's the last time that we closed down 1.5%. But even back then, Guy, we didn't see the VIX get above, 25 or something like that. So it speaks to the complacency that's been in the market. It speaks to just the enthusiasm, I think, for some of the biggest themes, this notion of broadening out. We had the Russell 2000 get back towards those prior highs. And I think a lot of investors were looking for other ways to kind of get long the market, because we've highlighted this again, the Microsoft, the Meta, the Amazon. I mean, these were not participating, over the last month or so, really since their earnings, and none of them had confirmed the new highs in the S&P over the last month. So you are not a believer in broadening out trades. You are not believers in all the cash on the sidelines, that sort of thing. Torsten Slok from Apollo had a great note earlier in the week talking about passive investing. That's something you've also been Just give me a sense of all of those sorts of things in one little bucket.
Well, I'm glad Torsten brought it up. And, as we said, I think on Market Call, but I'll reiterate here, he's saying it he's writing it far more eloquently than I have said it, but I will sort of emphasize his points. The advent of passive investing over the last 5, 6, or 7 years, the amount of money, passive money that's found its way into the market. By the way, I think we saw a record amount in the month of September, just anecdotally. I mean, that speaks to what we've been talking about. It's very hard to get in front of that freight train because passive investing, as Torsten pointed out, does not care about overbought conditions, does not care about any of the valuations that we talk about. Quite frankly, it doesn't care about anything because the money flows in. Now, with that, it's great on the way up. I mean, as he points out, this has been a wonderful thing for the investing community at large. Of course, the problem is, when passive becomes active, it's never active on the way up. It's active on the way down. And we've seen glimpses of that. So I'm not suggesting we're at the precipice of that, but understand there's the other side of the mountain when it comes to passive investing. And he did a great job pointing it out in his piece.
Yeah, the other thing, I just want to talk about, you just mentioned VIX at 21, right? So this is, we're recording this midday on Friday. By the time you're listening to this Monday morning, you're going to know where the markets close one way or another. I'm not particularly optimistic that we're going to see a meaningful rally into the weekend. Lots of stuff going on. Things have been turned up in Ukraine. Things have been turned down in, Gaza. The fact that President Trump is saying, well, I probably won't meet with Xi. That was something that wasn't scheduled, but it's something that he had kind of teased a little bit.
Mm-hmm.
On the tariff front, we came into this year with the tariff rate, the effective tariff rate across the board is like 2.5%. I think it's about 17, 18% right now. Why had we been saying, well, where'd the tariffs go? We don't even have deals, with the EU, with the UK, with China, obviously, but also with Canada and Mexico. We had frameworks of deals. And for some reason, investors bought that hook, line, and sinker, which made no sense to me. And, we keep seeing these companies that are reporting prior to the kind of the bulk of earnings, talking about Levi Strauss on Thursday night. The stock had a massive run. Just go check it out, people. Over the last few months, they were dealing with tariffs well. You know what I mean? And then all of a sudden, they give a good report, but they say, hey, listen, we're going to actually start to feel the tariffs, and we're going to actually have to start raising prices strategically. This could be a big theme, definitely towards consumer sort of products over the next, month or so.
Yeah, what I was surprised by, let's just round up and round down. So if you say the rate coming in was like 3%, which is probably close. And, if we're now probably somewhere around 15, probably higher, by the way, but let's just make it 15. So we're 5x where we've been over the last however many years. But the market, for whatever reason, completely looked past that. What I have said, and I think you've made the same point, somebody's paying for that 5x, and it's going to be a combination of the consumer, which it typically is, and the people on the other side, the companies on the other side. But neither one, it doesn't matter who pays for it. It's not bullish. It's not accretive to earnings. It's only bearish for earnings and for margins. Yet the market seemingly looked right past it and just chugged on its way. Now, I'm not suggesting people are going to wake up and start doing the math around this and say, well, wait a second. By definition, we have to see some margin degradation or some earnings degradation. I don't think, but with that said, they should start.
Yeah. It's also important to note that I think it was Torsten again. Sorry, Torsten. Well, not sorry. We love your work. Earlier in the week, we also saw a report out of him talking about the exposure to everyday Americans that they have to, let's say, the Mag 7, right? Because if the Mag 7 is essentially a top 10, 40% of the S&P 500, he gave some data, the average American who contributes to a 401k is about $8,500 a year. So you can do the look at that. You can do the math on, that exposure. And to your point about passive investing, and this is a big part of it, right? All the money that just goes into the S&P or the major indices, those top 10 names are, 50% of the QQQ, the NASDAQ 100, right? So when we have a sell-off like this, if the S&P sells off 5 or 10%, expect your favorite Mag 7 name to be down 15, maybe 20% on a 10% sell-off, right? And we're seeing that on Friday, in the broad market. The S&P, let's say, is down 1.5%. The NASDAQ's down 2%, but you see, a Tesla down 3%. You see an Apple down 2%. You see Amazon down 3%. The semis are down. The SOX is down nearly 4%, right? So like that's what you should expect. You enjoyed the upside, you enjoyed the passive nature, you enjoyed the low volatility, right? Which made you feel more comfortable and confident about this trade, but not too different than April. People forget NVIDIA was down 35, 37% from those highs in February. That can happen again. The last thing I'll say is if we do not have a trade deal with China and NVIDIA can't sell those chips and there is a slowdown in demand, these stocks could get cut in half. Let's just be honest right now.
Well, we've seen it before. You just mentioned it. We've seen it before. I mean, from the January high in NVIDIA, which was about 153 and change, I mean, that was a stock that I think traded in the mid 80s on that April low. So you can do that math you just did. And obviously we recovered and here we are now, but it has happened before to a number of these different names. And, it stands to reason with some of the rhetoric out there and where we are in the calendar and where we are in the VIX and some of the metrics that we've talked about. You have to start to look at these things, especially with the technical setup that we've talked about in terms of some of these engulfing patterns and say, maybe this is going to be one of those funky Octobers that we've seen before.
Yeah, and a lot of folks have been comparing this environment to, because of the Gen AI trade, to like 1999, 2000. You and I have not been in that camp. We'll be able to make that case at some point. We've been talking about the circular nature, of a lot of the investing in the Gen AI one versus the other and getting the orders because of the money that they just invested. Fine, whatever. This reminds me more of 2020 and 2021. We've had real stocks turn into meme stocks. We've seen filings of Chamath Palihapitiya is getting back in the SPAC game, right? And a lot of folks, whether it's S1s for IPOs, we've seen the IPO calendar open back up, and a lot of those have been kind of crypto related. If you have a protracted government shutdown, a lot of those things are going to get pushed out. We've seen a participation of crypto in all these treasury companies, right? It feels like that environment. We also had a theme back then, the metaverse. You remember the metaverse guy? You were in the metaverse, right? So
still am. I have my doppelganger or what do they call it?
Yeah. But I mean, like, that's the environment that we're in right now. And then we also have a situation where we're in a rate cutting cycle, which, has the potential to cause, another sort of move higher with a lower dollar and all this sort of stuff. But again, that's what it feels like to me. And we didn't record this thing on a Friday afternoon, the first big bad, to get everyone all nervous about things. But I think it's really important to remind people that April was not 4 years away, right? It was 6 or 7 months away. And so we're not going to have, panic like that, but we could have a sustained sell-off. And we've seen that go back to summer of 24. A lot of these Gen AI names had a really nasty sort of move. And it was one of those things, it was orderly, but they went down a lot.
Yeah, with all these levered products out there, that day we saw in April, that move we saw in the VIX in April, which, by the way, I think it actually may have put an 80 print up at some point. Whatever. I mean, regardless, it was a pretty unbelievable move to the upside in the VIX, which obviously is a significant move in the broader market, but it should not have necessitated a move like that. And I think, to me, that's sort of a precursor as to what we're looking at in the volatility index. I talked about this, I want to say August, September, that I thought we would see a 25 handle in the VIX shortly. That obviously didn't happen, but maybe it's just been pushed out a little bit. And I think given the setup that we're seeing, especially on a week now where we're going to start to see bank earnings. I mean, on Tuesday, think about who we hear from on Tuesday. Citigroup, Goldman Sachs, Johnson & Johnson, obviously not a bank, but an important company, JP Morgan and Wells Fargo, all on the same day. And then on the 15th of October, we're hearing from Bank of America. I think my views there, and Morgan Stanley. So you got all the big banks over the course of 2 days next week, again, in an environment where they've been unduly rewarded to the upside, I think.
Yeah, and so I just look at the implied move guy in the S&P 500. Maybe this one's more important to us because of all those names you just mentioned. They obviously are not in the NASDAQ for the most part, like none of the names that I'm looking at on the board for next week. But we have a 2% implied move between this Friday, okay, which was the 10th, and next Friday, which is the 17th, which is a little bit higher. CC's been writing this in our newsletter on a daily basis. The S&P has probably been implying a 1.2% move in either direction, from Friday to Friday. And, that's the sort of thing that you want to keep an eye on. At some point, if the VIX stays above 20 and you see increasing, implied moves over periods of time, you're probably getting towards a point where you might see some stabilization and a bounce. We're not there yet. And to your point about the banks, this could be a situation where some are good, some are bad. They cancel each other out. But if they're all good, I don't think it takes the market higher because a lot of those valuations have gotten excessive. And it's been kind of really, one of those situations where, again, passive has benefited those sorts of things. There's also all this narratives around, the lower taxes and the deregulation. And we're starting to see some consolidation in the regionals, that sort of thing. I'm not sure that helps in the near term. But if they all are negative and they start speaking to a weakening consumer, which a lot of the money centers did not acknowledge when they reported, 3 months ago, then you have a situation where you start looking at other sectors that are interconnected. If you look at the home builders, right? You got a 4%, 10-year right now, and those things are down at least 10% from their recent highs, so there's a lot of things that could have like sort of knock-on effects or cascade a little bit one versus the other, and there's very few things to get optimistic about. If all the Mag 7 guy increase their capex, and we know that they've been a huge part of GDP, do you reward those companies for that?
Yeah.
I'm not sure right now.
Well, I'm glad you mentioned CapEx because obviously, to me at least, the lion's share of what we've seen over the last year in terms of market movement has been built on CapEx, which has been announced without question, but also the belief that there's, and a word we use all the time, the sanctity of the CapEx, meaning that it's sort of etched in stone. I don't believe that to be the case because I do think there's a scenario that if things sort of went sideways and slowed down, you're going to see some of these companies sort of pull back a little bit. And even the slightest pullback, I think, on CapEx, given what's built into this market, is not going to be particularly bullish for the broader market. So we'll see. And listen, we've rattled off this, we've talked about the MIT study, the Goldman Sachs note, Roger McNamee, Paul Tudor Jones. I mean, a lot of people have brought up some of the things that we've talked about in terms of their concerns about, everybody can't win. But right now, that's what the market is saying.
Yeah, no doubt. Winning right now. Just quickly, let's just kind of look around the board. Staples are acting okay. Walmart's up 1.25%. We've talked about the underperformance of Walmart, but maybe it's one of those things where they win again in an increased tariff environment or protracted sort of trade war. Chinese stocks, as you would expect, are getting hit here. The KWEB is down 5%. The FXI is down 3%. I'm looking around. A software guy is relatively on a relative basis, outperforming semis. Obviously have been the driver. We've seen weakness in a bunch of these internet names over the last, these are, who they are, over the last few weeks. They continue to be weak. I think you got to keep an eye on some of these recent IPOs, Gemini and Figure and Bullish and Circle. They're all down a lot across the board, I think between 6 or 7%. And to me, that is just kind of somewhat of a view on risk taking because they were meme stocks. And then the last one, if you just kind of hit this for a sec, a lot of these private equity guys, whether it's Blackstone, KKR, Apollo, they have not been trading well for a month or two.
We brought up Apollo on Fast Money on Thursday night, and I'll bring it up again here. You think about, again, we talk about April all the time. We obviously saw what happened in April of this year. The market cascaded lower. Everything bounced from there. But then you look at a name like Apollo, which, made its all-time high, I want to say, in December of last year, early December of last year. We traded down to, I think, 102, 102 and a half, 103 in April. We bounced, but not nearly to the magnitude of the broader market. Now look at where we are now. I mean, we're fast approaching the levels that we saw in April. Not a lot of companies are doing that, by the way. So there's clearly something going on in the space. Doug Cass has pointed it out. You've talked about it. I've brought it up. I mean, you have to be focused on this. I mean, I'm not saying you have to trade these names, but you have to ask yourself what's going on behind the scenes. And we've mentioned the problems with Jefferies and the exposure that they have in terms of that bankruptcy and the exposure they have on their balance sheet, the fact that they kept a lot of that risk on their balance sheet. The point that I've made, and I think you've made as well, this is not going to be the last. And there are a lot of banks out there that probably have similar. So just stay tuned, folks, because I think all these things are trying to tell a story.
All right, two last things. Let's hit crude. Big down day. This is the first kind of like, I don't know, 2% move that we've seen in a little bit here. It's obviously been in this kind of downtrend over the last few months or so. But if you're thinking about increased tariffs, if you're thinking about lower, economic activity, right? This is one of the things we just saw from OPEC. They raised, the Saudis raised some output. If you go back and you look at that double bottom in April, we almost got to 55, I want to say, because then we had that rally and then we retested that level in May. So here we are now at $59 or so. But guy, if you go back, you go through 55, you got to go back a few years, right? To kind of see, you got to go back 5 years. You got to go back to COVID level times. And what is the weakness in crude overall telling you? Because again, the weakness, maybe it's a great input if you're an airline, and we just heard from Delta, last week and that sort of thing. But to me, it might say something differently.
Well, it's funny because President Trump actually, and I sort of discounted this because, he says a lot of things, but now I'm going back and sort of thinking about it. And he said something to the effect of, in the very near future, you're going to see gas prices significantly lower. I mean, maybe Amanda can find that tweet or truth, or whatever the hell they call it. If not, it's not a big deal. But the point is, when I heard it or saw it, I sort of dismissed it. And now, given what's transpired today, I'm just trying to connect the dots a little bit. So, listen, it's an administration that clearly wants energy prices lower, but there's also sort of this line in the sand where if energy prices get too low, it becomes very punitive to the energy companies in the United States. So you want to be very careful here. And yeah, lower gas prices, lower energy prices clearly are a tailwind to the consumer, but they're going to be more than mitigated by these tariffs that we're talking about. So it's that whack-a-mole game that I think a lot of people are trying to play. And it's a very difficult game to win because you fix one side of that Rubik's Cube and you only screw up the other two. And then you try to get the blue side to all match, but then that messes up the red side. And unless you know exactly what you're doing, that's a game you're playing in perpetuity.
All right. So gold, guys, started the year $2,600. It had this really orderly climb. Okay. And you saw, at 2,600 basically to about 3,400. You saw this multi-month from mid-April. Obviously, gold rallied during the rollout of the tariffs. I think it went from 3,000 to like 3,400. And then it consolidated, banged around basically between, I'm going to say 3,250 and maybe 3,450 for 4 months. You've been a buyer on every pullback, and then all of a sudden something happened as the stock market was making new highs every day, it seemed like, for a month or two, as the dollar couldn't get out of its own way, but it was just, it consolidated down in this kind of 98, 99. That's the Dixie. Then we saw the breakout, 3,400, 3,450, got to 4,000. It really felt over the last few weeks that there was a fever pitch going on every day. Front page Journal, front page Bloomberg, front page CNBC, and in like not only central banks, which you've been saying, but as retail got all in.
Yeah, well, the retail's been, if Costco sells out of their gold bars, a week into each month, and then they wait until the next month to get a new shipment. So, but I think you would know this, and I'll emphasize, as much as people want to point to retail, that's a piece of it, but that's not really what's going on here. What's going on is, as you mentioned, the central bank buying, which has been historic over the last 4 years. And I think it's going to continue on the same trajectory because I do think a lot of these countries are understanding the risks associated with central bank behavior over the last 20 years. And they're doing their best to create hedges that would theoretically protect them. Not only that, but, you're seeing a lot of these countries repatriate their gold, meaning that they want to have it within their borders, which is also, I think, very interesting. So, the gold trade may take a breather, what I've pointed out, and what I think could happen. Gold does sell off in a broader market, equity market sell-off. It's not impervious to that. But if you, in fact, were to see a pullback to those flattening out levels of like 3,550, 3,600, I think you get right back in the game. This gold trade, in my opinion, Dan, is far from over.
Yeah, well, you were a buyer on pullbacks the whole way up, and there were some good ones to buy. There might be a healthy one given just the sentiment towards it right now. It seems everyone's on one side of the boat. We did have this kind of near parabolic move, so we'll see what a sell-off might look like, but it would be nuts if it goes from 4,000 to 5,000 in a straight shot. I think we'll see a very different world if that is the case. All right, guys, we got a big week as far as content. Liz Thomas of SoFi will be on with us. We got a really great one I'm excited about. On Thursday, which will be a Friday drop, we have Danny Moses, Vincent Daniel, and we have Porter Collins, and then you and we're allowed to join that one, which is pretty cool. So we're going to be the 5 of us. I don't think we've done that in a couple years.
Hopefully there's space in our studio.
Bill's going to make it happen. He looked at me and said, I'm not sure. And I was like, you're gonna, because I'm not sitting on Guy Adami's lap. All right. Thanks for tuning in here, people. What a day. Let's see if we get some follow through Friday into Monday, because that's not something we've seen in a while. So thanks a lot for being here.